Welcome to ETF Leaders, powered by the New York Stock Exchange. Joining me today is Briton Ryan. He is the head of capital markets at Nuveen. Briton, great to see you. Thanks for joining me.
Yes, thank you for having me.
Now, Briton, with today's market volatility, how can investors best manage their risk?
Well, it's kind of a funny thing, right? There's this age-old saying of, don't try to time the market, but it's true, don't try to time the market. But with that, you have to understand what environment you're in, and then you have your core portfolio that you want to rebalance around that environment. So right now, what do we know about our environment? We have inflation, persistent inflation. We know that the federal government is tightening monetary policy, raising rates to fight that inflation, and when they do that, that generally impacts growth. So when you're thinking about your core portfolio, you don't want to just be buying dips or selling because something went down by some arbitrary amount. You need to think about those three factors. And today, to me, what that means right now is really shorten duration and be defensive in this environment.
All right, and what's your big area of focus for the second half of 2022?
It's that environment. What are the factors that are going to change those things? So if I'm saying to you that the environment right now is to focus on persistent inflation and slowing growth and tightening monetary policy, well, what's going to change that? So we know that the Fed's going to be looking at CPI because they're monitoring inflation. We're also going to look at GDP to monitor growth and corporate earnings. And we're going to look at the path of the Fed. So right now, the Fed has outlined that they want to hike 50 basis points both in June and July, and then likely 25 basis points thereafter until they get to about 2.5% to 3% sometime early next year. In a perfect situation, if they did that, we'd have a soft landing, growth might come back a little bit, but we'll tame inflation and we won't go into hard recession. So we're looking for the factors. If we can stay on that glide path, stick with the investments we've got right now. But if we have a situation where the Fed has to hike more because inflation's not coming in, or just by taking this course of action, growth is really getting crushed and we have consecutive quarters of negative GDP or really hurting earnings, we may have to take a more defensive posture against a recession in our portfolio instead of really hedging against inflation.
And what guidance would you provide investors considering raising rates?
One of the things that people keep seeming to misunderstand is they think stocks go up, bonds go down, stocks go down, bonds go up, but that's not necessarily always the situation. It's not always risk on, risk off. This is a perfect example of that. Rising rates, prices of bonds are going down while the prices of stocks are going down. So duration really hasn't been a good risk-off hedge in this environment. So what we're really saying to investors is shorten your duration, but understand this isn't a credit event. So you can still think about things like high yield and munis that have gotten hit really hard, but now are providing really interesting yield returns, or even dividend growers like our ETF, NVDG, the Nuveen Dividend Growth ETF. It's a great investment for this type of market environment and rising rates.
All right, Briton, great to talk with you.
Thank you.
And that's ETF Leaders, powered by the New York Stock Exchange.